What's up, everyone? My name is Ale. Welcome back to my world of stocks, and welcome back to my stock market monthly update series for the month of December 2023, the last episode of the year. Now, in each episode, we do just a really quick update on the current state of the stock market and the economy by splitting it up into three parts. Now, in part one, we take a look at the current performance of the stock market and how things are going so far. In part two, we cover any broader economic news and updates that are affecting the stock market and where it may be heading in the future. And then in part three, we just finish up with kind of like a really quick rapid fire of the biggest individual gainers and losers of the past month to see if any stocks catch our eye there as well. But overall, it's just kind of a fun little update on the stock market. I love doing these videos for you guys, and I hope you're enjoying them too. So let's not waste any more time. Let's go ahead and dive straight into it, starting with part one. Alright, so taking a look at the stock market's performance, you all probably noticed that November was a very strong month. I think it was probably the strongest of the year, with the S&P 500 rising a whopping close to 9%, leaving it up almost 20% year to date. Pretty strong year there. And it also leaves it up over 66% in the past 5 years as well, while only being down now about 5% from that all-time high, which is a little scary to see in this economy, but we'll talk more about that in just a second. As for the other two major indexes though, the Dow Jones Industrial also rose close to 9% in November, with about the same year-to-date performance, which leaves it up over 40% in the past 5 years and only down 2% from that very top, while the tech-heavy Nasdaq saw the best performance of all at over a 10% rise in November, leaving it up over 35% year to date and almost 100% in the past 5 years. However, it is down double digits from the very top at about a 12% drop. But again, overall, some very strong performance for the markets this year, which is not very encouraging to see when the broader economy is actually doing so poorly. However, there's actually more to this story than people might realize, as it's really just the biggest, most popular stocks that are kind of pumping everything up, while the rest of the market isn't really performing nearly as well as you might think. In fact, this recent chart here from JP Morgan shows that the largest 7 stocks of the S&P 500 are up over 70% this year, which are really lifting up the index as a whole by over 18%. But if you look at the remaining stocks, they're actually just barely up by around 3%, meaning that while it may appear that the markets are up a huge amount and everything is super expensive right now, considering especially the weak economy, the fact is that they're actually not up nearly as much as you might think. And it's really just kind of the biggest, most popular or trendy stocks out there that are really causing that impression, especially the ones tied to tech, to growth, and to artificial intelligence, where we've of course seen a lot of hype enter into some of those names, especially this year. But in fact, there's still many great stocks out there that I do think are worth buying at reasonable prices right now, which I continue to put out many videos every single month talking about them. But yeah, just kind of overall, I would say there's a bit of a mixture right now. Yes, many stocks are way too expensive, but there is still some value to be had in certain areas of the market if you're willing to kind of search out those different stocks. But with that said though, that'll bring us now to the second part of the video where we cover any broader market and economic news, which, as we all know, things have not been looking very good right now with the macroeconomy, and the fear of a recession just really kind of keeps on rising, which is of course tied to inflation and interest rates right now. So starting with a quick recap on our current inflation first, we have now seen it fall from over 9% in the middle of 2022 down to just 3% in June of this year, which was a direct result, of course, of our rising interest rates. However, it then surprisingly climbed back up to 3.7% in both August and September, before now coming back down again to around 3.2% in October. So if the trend continues, we could see it continue to fall in the coming months, and hey, maybe even get down finally to that 2% target rate that the Fed is always aiming for, or at least something close to it. Now, we don't have November numbers quite yet, as those tend to come out around the middle of the following month, but overall, I would say that it's not looking too bad on the inflation front as long as it continues to trend downward. However, that's clearly not the biggest issue anymore, as that honor now goes to our persistently high interest rates that risk slowing down the economy so much that it could send it into a recession, as we have now seen one of the sharpest inclines in history and currently hovering around 5.5%, which is also the highest it's been in decades. But because of all of that, I don't really think that we're likely to see many more increases in the future, if at all, with bond traders currently pricing in a 98% chance that the Fed will not make any changes to it in the next Fed meeting scheduled later this month. And we could even see a rate cut by next year, which I'll touch on in just a second. But in terms of the risk of recession at this point, I mean, pretty much every indicator out there continues to signal for one, and they have been all year long, which I've covered extensively on my channel already, so I won't bore you guys with all of those same details again. However, GDP numbers are actually still looking pretty strong despite all the headwinds, which we actually just got a report for the third quarter GDP numbers, and we saw a GDP growth of over 5%, which is pretty strong. And it now marks 5 quarters in a row of consecutive growth ever since the little recession that we had at the start of last year. However, it's strongly believed that our high interest rates will quickly erode that growth in the coming quarters, which we're already seeing many signs of in various parts of the economy, like in gross domestic income, for example, which declined for the first time in 3 years. And the only other time that it's happened, by the way, where we were not already in a recession was near the end of 2007, which was, of course, followed by a gigantic recession right after. So this could be kind of an early warning sign that it may happen again. On top of that, though, retail sales also fell for the first time in 7 months in October. We also saw job growth continuing to slow down. Unemployment rose to nearly a 2-year high. And all the meanwhile, the rate hikes have also caused home sales to plummet with another nearly 15% drop in October, leaving us now at the lowest levels that we've seen in 13 years, with this year as a whole also set to be the weakest year in over a decade. So that's pretty bad. But it doesn't even stop there. We also just got another new report from the Fed showing that economic activity slowed throughout the past 2 months, with more than half of all districts reporting either flat or declining activity. And as a result, financial markets are now anticipating an actual rate cut happening mid-next year. However, the bright side to all of this is that, again, inflation is at least coming down, which if that continues, then economists think that the Fed will actually be finding themselves possibly in a sweet spot where the economy is still growing and consumers are still spending, even if it is at a much slower pace. But then the Fed will also, still have that ability to lower interest rates, and the economy could be lifted back up without ever even going into a recession in the first place. Or even if we did go into a recession, it would probably still be just like a very short one anyway. And look, I totally understand that the economy is trash right now, and I know that some people don't like how optimistic I am in some of my videos, but as a long-term investor, I just kind of naturally try to look over the horizon and see where things can start to go well again, because that's the future that I'm really investing towards. So as long as we have high interest rates, it's also just kind of hard for me to panic about that or not see the positive side to it, because I also know that that's just pure ammunition for sending the stock market soaring again whenever the Fed decides to pull that lever. And hey, look, in the meantime, if the high interest rates can at least cause some of these zombie companies to go away that have been living off of like ridiculous levels of debt for so many years, and maybe it even causes a lot of people to finally wake up and start paying attention to and actually caring about our economy, maybe these high rates aren't so bad after all, or at least maybe there's some positives that we can look to from them. Now, they definitely shouldn't stay this high, but maybe for a little while to kind of correct things a little bit. I think, in the end, I think maybe we'll be better off taking some short-term pain right now so that the long-term picture is maybe a little brighter. But that's enough rambling from me, guys. Let me know what you all think about everything I just said down in the comment section. But it's time now to finish up the video with part 3. We're going to run through the biggest gainers and losers of the past month, and I'll let you know if any of these individual stocks catch my eye here as well. All right, now because the market was up by so much, there unfortunately wasn't anything super exciting this month, but I'll just quickly run through these starting with the biggest gainers first. At the very top, we had Affirm Holdings post the biggest gain with over a 113% rise in November. Now this is the fast growing buy now pay later company that has been on fire this year, not only being chosen by Amazon to partner with, but also smashing last quarter earnings report, beating on both the top and bottom line, while also raising their guidance. And yet, even after soaring by almost 300% this year, the stock is actually still down a whopping 78% from the highs that they reached during the pandemic, where, of course, online shopping was through the roof and those type of related stocks were skyrocketing. Unfortunately, though, their valuation is still pretty rich even after the fall, as their price to sales ratio is still hovering above 6, which is about 3 times higher than the sector median of around 2. And while their sales have been soaring, so too have their losses by about the same rate. So it's a little too speculative for my taste, but still a fun stock to track nonetheless, and a very volatile one at that. Apart from that, though, several other popular stocks soared too, including the streaming platform Roku and the crypto giant Coinbase, who both rose over 70% each. The fintech Block rose over 58%. The biotech CRISPR Therapeutics rose over 56%, which is, of course, one of Cathie Wood's favorite stocks. And we also saw the online shopping giant Shopify rising over 50%. And the travel giant Expedia also rose by close to 50% as well. CRISPR would probably be my favorite of the bunch though, because I do see a lot of future potential with gene editing in healthcare, but I'm not personally invested in any of these stocks at the moment. Scrolling down though, another video streamer in Paramount rose over 40% after the Wall Street Journal reported that they're in talks with Apple to possibly bundle their streaming service Paramount Plus with Apple TV Plus in order to better compete with all the rising competition in the space. Personally, I think Apple is of course the larger, safer, and much more diversified option of the two, which I am already invested in, as well as Disney and Amazon as well. A couple other stocks I own too though include Duolingo and Palantir Technologies, who both made the list this month, rising by over 40% and 30% respectively, which I was pleased to see. Although admittedly, I kind of wish that they were falling instead so that I could buy more at cheaper prices. But either way, I love what these companies are doing, especially with artificial intelligence, which Duolingo uses for teaching new languages, while Palantir uses it for data management and analysis. And really, both have just been on fire lately. And then just a couple other notable mentions. Carnival Cruise rose about 40%, while the Chinese e-commerce company PDD Holdings also rose by about the same amount. And I do actually happen to kind of like them for their future growth potential, particularly through their Temu platform that has been on fire lately and really soared in popularity thanks to the big discounts that they offer on the platform. Especially here in America, it's really become one of the most downloaded apps of the year, and it's already grown to over 250 million total downloads globally as well. Unfortunately, though, the stock has already risen by over 500% in the past 5 years, so I'll probably be waiting for a dip myself, but I still enjoy tracking it. It is a fun one to keep an eye on. Finishing up though with the biggest losers, again, not much to report this time as it was mostly a positive month in the market with only one stock on the list even falling over 20%, and that was Bill Holdings, a fintech that helps mostly small to medium-sized businesses with their invoices, and the stock recently fell after reporting earnings as they did grow sales by over 30%, but unfortunately gave weaker guidance for 2024 because of that weak macro economy where businesses will likely spend less, and thus Bill would be collecting smaller fees as a result. I actually kind of like this one though as a speculative fintech that is down a lot right now, but the valuation is still a little too high at over a 6 PS ratio, so I may wait a while to see if it gets dragged down any lower. One stock I do own though is Alibaba, who continues to get crushed, falling another 10% this past month, leaving it down almost 80% from the top and trading at one of the lowest prices we've seen in the past decade. And I actually just mentioned them in my 3 stocks for December video, so if you want to learn more about it, I highly recommend that video. But yeah, I will very likely be buying more of this Chinese e-commerce giant as it continues to fall. Apart from that though, Fortinet fell over 8%, pretty good cybersecurity stock there. And scrolling down a little further, we had the tech company Cisco fall over 7%, the retail giant Walmart fall over 6%, and the biggest pharmaceutical biotech in the world, Pfizer, fall over 5% as well. Putting any kind of controversial or personal topics and opinions about the company aside, though, I would say that Pfizer is probably my favorite stock of the bunch here, which I do already own myself, as I just kind of feel like everyone is focusing so much on the falling sales of the V shots coming out of the pandemic that they're forgetting just how much money this company has already made from it and how they're using that money to invest in future growth initiatives, still doing around 50% more sales next year than even before the pandemic ever happened. So while the stock is down super hard right now and trading at the lowest levels of the past decade, I will probably be using this as a buying opportunity for the long term. But besides that, all the other stocks on the list were only down by less than 5% each, so I think we'll just go ahead and stop right there. Let me know what you all think about everything we discussed today, about the current state of the stock market. Let me know if you're buying any stocks out there, if you're making any moves. I'd love to hear your thoughts. Thanks again for stopping by, my friends, and for all of your support. It means the world to me, and I will catch you in the next video. Hope you're all doing well. Take care, everybody. Bye-bye.